Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We'll begin with crude oil today, which is moving higher for a fifth straight session as the market assesses the widening fallout from the U.S.-Israeli war against Iran. And the combatants are vowing to press on. Now we are learning that Kurdish Iranian dissident groups based in northern Iraq are preparing for a potential cross-border military operation in Iran. At the same time today, we're seeing a rebound in equity markets across the Asia-Pacific after an up arrow story for U.S. stocks. In South Korea, for example, a powerful rebound is underway following Wednesday's 12% sell-off for the Kospi. For a closer look now, I'm joined by Bloomberg's Lianting Tu. Lianting is managing editor for Asia Equities, and she joins from our studios in Singapore. Thank you for being here. Can you help me understand what's going on with the South Korean equity market today?
The story about Korea basically is a cautionary tale about leveraged bets to buy into stocks. Yesterday, we saw, the record sell-off ever for Korean stocks, more than 12% drop. And that was really because the retail investors leading into the war, going into the war, they were just wrong-footed, right? They took out a record amount of debt and they also put a lot of money into brokerage accounts just sort of to get ready to buy more Korean stocks. So a lot of that buying was really financed by debt, by margins. So that has caused a lot of liquidation in a day when the market plunged. So we see a lot of technical reason behind that, right? Forced liquidation, a lot of gapping down, and that's a result of a historic slump that we saw yesterday. But today, I think there was a lot of buy orders leading into today's open. Again, retail investors, even yesterday, some of the brave-hearted were buying into long leveraged ETFs. So there are a lot of sort of still bullish people out there looking to buy the dip. So today's huge rebound is reflective of that. And foreign investors yesterday, I wanted to highlight, they were actually already buyers. We saw at the end of the day about $1 billion of foreign inflow into the market yesterday. So that kind of inflow, I think, today is translating into the big jump up as well.
So when you look at market internals, Lianting, is it still technology related, and is that trade directly correlated with artificial intelligence?
Yes, it's very much so. I think Korea, if you look at the overnight trading in a Korea ETF in the U.S., there was almost no sign that there was a big crash in South Korea, earlier in the day. The EWY, I think that was a ticker for the iShares Korea ETF. It was up during the night, and there was still flows into it, which means global investors, not just the Korean ones, are still sort of very much bullish about this Korea story about memory chip shortage, about how they're being well positioned in this AI supply chain. So that to me is quite shocking, right? Almost to global investors, nothing happened in Korea. People continue to buy into this US ETF of Korea.
So, Lianting, we're getting some headlines out of the National People's Congress in China. The growth target has been set in a range of between 4.5% to 5%. I think that's the most modest we've seen in about 3 decades. Some analysts were saying earlier this is, in effect, an admission that China's model, the economic model that has powered the country's rapid rise, is now beginning to show a little strain. How would you describe what's emerging from the NPC?
Yeah, the growth target of between 4.5% to 5% has been very well telegraphed. So that bit of information is not a surprise to market participants at all. Xi Jinping's government has been talking about how they wanted the quality of growth, not just a pure number in the GDP figure. So that's, again, well understood by market participants. So we've asked 10 people so far on what's the takeaway. Everybody has has said right now they're not seeing market-moving news so far out of the NPC. The stuff that came out, including promotion of a humanoid robot and also the AI-related industry breakthroughs, and all that has been sort of reiteration of what we heard before. And I think one more thing to watch out for is the kind of plans to boost consumption, to lift the proportion of consumption in China's GDP. That we haven't really seen anything super concrete that has come out of yet. But so far, I think Chinese market today is just being lifted along with global markets. Asia so far has been the worst hit in global stock market since the war began. I think China wasn't spared. And today, again, it's just sort of the rising boat lifting all tides.
We know well that the story in China lately in terms of prices has been one of deflation. And so the government set a CPI growth target for this year of around 2%. How do you think they're going to achieve that? Is that going to come strictly from more government spending?
There has been room for fiscal spending. I think the deficit is still at record high. That was the latest target, 4%. But it is very, very challenging work to get CPI up 2%. Part of it is because there is a lot of competition and a lot of sort of glut of supply in all sorts of things, materials, even services that we saw in China. Part of it, as we reported, is this, even in the tech space, right? Food delivery war that's been going on. Of course, solar is oversupplied. Lithium is oversupplied. And latest oversupply that we're seeing is actually AI application models. Every other tech company has an AI model that they wanted to promote. And that has really added pressure on all these internet names, stock names, I should say, just because they're spending so much to get user signups for their latest AI app. So that's really pressuring margins. Again, that doesn't reflect well for their stocks in the stock market and overall for the economy. That just adds to challenge of reaching that 2% CPI goal.
I mentioned the push higher for crude oil, and when you consider economies like South Korea, like Japan, that are heavy oil importers, what is the sense of the risk of inflation picking up as a result of higher oil? Is that something that people are talking about? Is there a great deal of concern being expressed along those lines?
Not really for China. The interesting thing about China is China's now touted as the biggest beneficiary of this oil crisis that we're seeing right now. Part of it is because China gets its oil, from Russia mainly, right? And also it can still get from Iran. It can still get from Venezuela. So China actually has a lot of friends in the global south to get oil supply from these countries. So that sort of spared China from buying the recently surged oil prices. So it's a very well-positioned market when it comes to energy supply right now.
So I mentioned the conflict with Iran earlier, and another headline that has emerged from the NPC is China's plan to increase defense spending by 7%. That's the slowest since about 2022, and I'm curious as to whether anyone's surprised by that number.
I would say yes. That's probably one surprise that has come out of the NPC so far. But there are people saying that, China, the official number may be 7%, but China has many other ways to spend on defense. So the actual number that may not be released to the public could be a lot higher than that. And of course, for China, defense is just becoming increasingly important as we're seeing what's going on in Iran. There's a lot of concern about, what's going to happen to Taiwan in the next couple of years before Xi Jinping steps down. So I would say defense is of critical importance, and China really, will not that slip in terms of the technological breakthrough in the defense sector relative to the rest of the world, especially with the U.S.
Lianting, we'll leave it there. Always a pleasure. Thank you so much. Bloomberg's Lianting Tu. She is managing editor for Asia Equities, joining from our studios in Singapore here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Financial markets are still facing tremendous uncertainty as the conflict in Iran enters its fifth day, and it shows no sign of abating. Tehran is targeting Israel and Gulf states, and at the same time, Israeli and U.S. forces have been bombing targets in the Islamic Republic. That would include the U.S. sinking an Iranian warship in international waters. It was on Tuesday when Goldman Sachs CEO David Solomon expressed surprise at what he called the market's benign reaction. On Wednesday, Solomon spoke with Bloomberg's Heidi Stroud-Watts in Sydney.
Your team of strategists, led by Peter Oppenheimer, is saying buy the dip. Do you see complacency at the moment?
I don't see complacency. I think there's a lot of uncertainty around the direction of the conflict, how it'll be resolved, what the off-ramps are. And, I think it's fair to say when you look at markets, market reactions have been relatively benign. And I certainly could have seen over the last couple of days, a little bit more volatility, but I don't think people are being complacent. I think that market participants are looking and trying to say, how is this going to play out? What's the end game? You can see, good scenarios and more difficult scenarios. And as they have more information in the coming days, the coming week or two, I think that will have an impact on risk premiums. I think at the moment what market participants are really looking at is this going to translate through to things that affect economic growth and activity, particularly energy supply chains? So far, I think one of the reasons why markets are reacting the way they are is they're encouraged that there's strong support for trying to ensure that doesn't happen, but it's uncertain. You don't know, and we'll see. In the long run, for portfolio allocation, and I know Peter Oppenheimer, Sharmeen Mossavar-Ramari did a call for our wealth clients. If you have portfolio allocation, there's nobody that's saying you should change your fundamental portfolio allocation because of what's going on. But for traders and day-to-day market participants that think about risk premia, every single day, obviously they're watching very closely.
What about the people that run big, major global banks like yours, right? Do you worry about the lack of predictability when it comes to policy, when it comes to how this potentially ends and when it ends? What's going on with your Middle East operations, for example?
I worry about a lot of things. We run a big global business. We have an extraordinary team. And, I think one of the things that we have to accept is the world is a very complicated place. There's always a lot of uncertainty. There's always a lot of nuance. But we have, base beliefs on how economies will perform, how the world will evolve. And, we operate around that, but we always are prepared to risk manage and think about downside risks. And I think one of the things you have to do when you run a big, large financial institution is that when, facts change or risks come up, you've always got to be prepared to pivot, to shift, to de-risk. And, we run our business, that way always. We run a big balance sheet, and we think about that every day. But there's nothing, while these are very, very significant events, and I don't want to diminish them in any stretch, we've operated the firm through lots of very significant events year in, year out, and that's part of what we do.
Is it business as normal then for, say, your offices in Saudi Arabia? Is there still travel going on? What's the communication being with clients?
That is complex. We've got a significant number of people in those Middle East countries, and obviously first and foremost we're concerned with their safety, and we're trying to do everything we can to support them and their families. I would not say it's business as usual in those markets. All those markets for all businesses are operating work from home and stay safe as a first priority, and so we'll just have to watch closely how things play out, and we're very, very focused on making sure our people and their families are safe and sound, and at the moment that's our primary focus in that part of the world.
Do you think there is a bit of an existential cloud over Dubai as a financial center now?
Well, I do think safety and security, matters. And I wouldn't say, I think it's a little bit premature to talk about existential clouds. But, if you're living and operating in a place and you didn't anticipate this, it's quite scary and it's quite unsettling. And so, as I said, our primary focus is on the safety and security of our people there. And we're working very hard to make sure that we're protecting them and their families.
It's not as though the background prior to this conflict was crystal clear, right? We just came off really trying to work out what the AI scare trade was going to be like. Do you still think that when it comes to that narrative of sustainability, of, I know Jamie Dimon said there's some players doing dumb things, for example, does that still have further to go?
I'm not sure I understood the question exactly. Are you talking about kind of AI investment, growth? Look, AI is a fabulous, fabulous, incredible technology that is going to drive massive productivity gains through society. There's a lot of capital being deployed to grow AI capabilities around the world. Some of that capital is going to get reasonable returns. Some of that capital is not. There are going to be winners. There are going to be losers, as within any technology super cycle. I think we're early in that process, but I think it's exciting. And I actually look at the glass being half full. That doesn't mean that there won't be capital that's burned, companies that don't work out. But I think overall the benefits to enterprise, productivity, the economy broadly as this technology gets developed and deployed is going to be quite exciting. And I'm looking at the optimism of, what's ahead from all of this. And of course, trying to manage the risks and the downside and the speed bumps that will inevitably come along the way.
I like that earlier you said, in your job, you worry about a lot of things, right? Trade, tariffs, US policy is obviously one of them. And I think this is the first time we've spoken to you since the Supreme Court passed down their judgment. Does the further lack of predictability on trade policy, is that also a concern when it comes to business sentiment, when it comes to your views on how the US economy is going to cope?
I think uncertainty does affect business sentiment broadly, but I just say I don't think that at the moment U.S. trade policy is that uncertain. I think this administration has been clear about how they intend to drive a trade policy. I think the Supreme Court decision affects a certain discharge of tariffs into the economy, but there's certainly other avenues for the president. I think the president's made quite clear, how he thinks about tariff and trade. And I think while this administration is in place, that is going to be a construct that we have to operate in. Of course, if there could be more certainty around exactly how that looks, and I think the important thing is how it will look in longer perpetuity, of course the market would appreciate that, but I think the market operates knowing that there's a level of uncertainty around trade and trade policy that we just have to adapt to and we have to live with.
I wanted to get a bit more on why you're here, for example, in beautiful Sydney. Do times like this of increased global uncertainty, does it make a relatively more idiosyncratic market like Australia more interesting?
Well, Australia's always been an interesting market. We have 400 people here. There are a lot of very, very important, companies in Australia. We have a good wealth business in Australia. Australia is an important market and an important economy, not just for the world, but also for Goldman Sachs. Any market, any economy that's important is important for Goldman Sachs, given our global footprint. I try to get here about once a year. I try to do it around an event like this, so we've got a lot of our clients brought together, first of all, for this conference. But this has always been, an important market, an important economy for Goldman Sachs, and I think that's consistent, in any environment. So I was here the same week last week, and I'm excited to be back again this year.
What else are you excited about around the region? I know as a house view, Goldman Sachs is very bullish on China. It's, of course, National People's Congress week as well. What's your feel about that market, given some of the crosswinds on trade, on tech, on geopolitics?
Yeah, China's one of the largest economies in the world. It's going to continue to be one of the largest economies in the world. At the moment, I'm very focused on the bilateral relationship between the U.S. and China. I'm looking forward to President Trump's visit with President Xi that's planned for later this month, the beginning of April. It'll be interesting to see what comes out of that and, whether or not China and the U.S. can make more progress, on their bilateral relationship. I think that's important for growth in the world, and I think it's important for both the U.S. and China. And I think at the moment that's fragile, and so I'm very curious to see, how that progresses. In the meantime, Chinese markets have done very well in the last 12 months. That's increased capital flows, into the region. We obviously participate in that, but we're going to watch those bilateral meetings and progress in the bilateral relationship very closely.
What would you like to come out in terms of deliverables from that meeting?
I'd like to see, more certainty and clarity around how the bilateral relationship will work going forward. I think there are things that the U.S. wants, there are things that China wants. I'd like more clarity around what that's going to look like, not just in 2026, but, over the coming years. And I think that's still relatively uncertain.
What are we not talking about enough? I know we've talked a little bit about private credit. You don't think it's sort of a systemic risk at this point?
I think credit formation around the world is really correlated to, economic growth and economic activity. I do think that we've gone, if I just look at the U.S. market, which is obviously, when you talk about private credit, a very, very large market in the context of private credit, we've gone a long time without a credit cycle. We've gone a long time without a recession. I do think when you have these long-dated cycles, there are a variety of things that happen. One, credit spreads narrow. Two, lending standards, people have more capital to deploy, they get aggressive. Lending standards deteriorate a little bit. Due diligence standards deteriorate. And so we're watching very closely to see if there's been a little bit too much aggression, frothiness in those markets. But fundamentally, when you look at the underlying credit portfolios, particularly below investment grade credit, while there have been a bunch of idiosyncratic events where there have been problems, the broad portfolios are performing reasonably well. Why are they performing reasonably well? Because the economy is doing fine. And it's very hard to have broad underperformance in a broad diversified credit portfolio if the economy is doing well. When we do have a slowdown in the economy, you will see it. I think because of the length of the cycle, you probably will find places where the losses are higher than people expect. We're very, very focused on back leverage and things that could affect or amplify in a more difficult economic environment, credit deployment. But at the moment, when you look broadly across portfolios, we're not seeing things that are super concerning. That's a completely different issue than retail participation and retail investors wanting liquidity from what are fundamentally illiquid products. And so that's getting a lot of attention, but that's different than the underlying credit portfolios. But I do think that when there is a slowdown in the economy, or we do get to a place where we have a recession, you're going to see losses in credit portfolios, and those losses could be meaningful. But we'll watch that closely. While the economy is chugging along, that's not the primary focus.
That was Goldman Sachs CEO David Solomon speaking with Bloomberg's Heidi Stroud-Watts at the Goldman Sachs Australia Week Alternatives and Macro Summit, bringing you their conversation here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.